Well, good day, everyone, and welcome to the Why We Plan podcast. My name's John Brown. I'm the founder of BEI, and I'm interviewing various guests on this podcast. With me today is a long time, and I mean long time, business valuation expert and BEI member who's done hundreds and hundreds of business valuations, who's done dozens and dozens and dozens of exit plans. And he and I are going to talk today about business valuations, what you should look for, what they cost, when you don't need one. So Don, welcome today.
John, thanks very much. I've had a wonderful long association with you, John, and BEI, for which I'm very appreciative. And as I've told you before, it's allowed me to develop professionally in a way that has been very rewarding during my career. So I'll just give you a brief introduction to who I am, my brief story. I call myself a recovering CPA. And it's a 12-step program. I'm at about step number 11, so I've been at this quite a while. But I used to be a partner at a regional CPA firm. I was actually head of the tax department at this firm for a while. And in the mid-1990s, I discovered first business valuation and then exit planning. And I began a transition on my 12-step program from being a CPA to a valuation analyst and exit planning expert, if I can be so bold and so lacking in humility as to call myself an expert. But I've been doing this for 25 years. I use business valuation really as the foundation for the exit plan. And I think you'll grow to see why I think that gives me a real leg up in helping business owners navigate a successful exit out of their business.
Yeah, so what I want to talk about today is, so we can actually talk about anything, but one of the issues I think owners have, and this is directed mostly to advisors and business owners, and certainly advisors have, is starting off planning for the future with a value of their business in their mind. The owner has this idea of what the value of her business is, and that can be a serious barrier to actually beginning to do planning or thinking that they even need to do planning. So I'd like you to, first of all, address that, maybe just what the need for valuation is. And then, there are all kinds of different valuations that one can have. You have sort of the opinion of value, a calculation of value. What we see a lot of right now is software-derived valuation of a business, usually biz equity or in life insurance company's valuation software, and what you think of that. And then lastly, the owner's opinion of value. And we may talk about, what we recommend our members do when they know their owner wants to sell to a third party and it's a significant business, is we would like them to talk to an investment banker to get an idea of the likely sale price, because they've got their databases, they know what things are selling for today, what multiples, et cetera. And that seems to be a good way of determining sale price, not so much value. So just talk about all those different things, and maybe the relationship. You're doing exit planning, how you begin an exit planning engagement from a valuation perspective, but also from an exit planning perspective.
I wanted to give you a little bit of my personal experience in the relationship between business valuation and exit planning. And I have a funny story to tell, which I'm sure John will find amusing, but back in the 1990s, I was one of the first members of NACFA. My membership number is like 350.
Wow.
I think I wasn't in the first class, but I was in the second class. So NACFA was a struggling organization back then. And after my first year of membership, they sent me a renewal. And they said, you know, if you renew within 30 days, we'll send you a free copy of a book. And that book happened to be John's book, How to Run Your Business So You Can Leave It in Style. And I got this book and I thought, wow, this is kind of all about business valuation and how you can use business valuations to create a good service for business owners in helping them exit their businesses. So that was my kind of initial connection between valuation and exit planning.
Yeah, I did not know that.
Yeah, and you know, I didn't know who John Brown was. I didn't know who BEI was, but I bought about 50 copies of this book and I would give them out to all my clients. So what does that mean as a practical manner for exit planning when I do a business valuation? First of all, I'm going to say that the most important thing from my perspective about the valuation is not necessarily the value. In my reports, and I'm typically doing a calculation of value report, which is from in my work is a pretty extensive report. It's maybe 40 pages. It looks at the history of the business, the industry, the financial analysis. But the key thing that I am driving towards in the first section of my valuation report are what are the risks and opportunities for that business? Because valuation is a forward-looking enterprise. You know, it's great to know what the historical financials are, but really to value a business, you have to take an educated guess as to the future cash flows of that business. And in order to understand those future cash flows, or take the best educated guess you can, you have to really understand what the secret sauce is in that business, what really makes it tick. And that's why I have this one-page summary of what I call the risks and opportunities, or the strengths and weaknesses of the business, to try to give the reader and myself some understanding of what the future of this business looks like.
Yeah.
Now, nobody has a perfect crystal ball, and my crystal ball is not perfect either. But that's what investing in any business is all about, understanding where the business is today and where it's going in the future. Mm-hmm. So that's number one. These strengths and weaknesses can include a whole panoply of aspects of the business, their management structure, their product development, their marketing, their customer service. But every business is distinctive. And what I try to do in this report is first and foremost give the owner an understanding as best as I'm able to tell as to what the strengths and weaknesses of that business are. Mm-hmm. And, you know, John, you properly talked about understanding the value of the business. And that, of course, is important. And owners frequently don't have a good understanding of the value. But just telling them a number is not necessarily so helpful. You have to be able to explain to the owner what's behind that number. And, you know, a business owner might tell me, well, you know, I think my business is worth $10 million. And I'll say why, and they'll say this, that, or the other thing, and not necessarily taking the most objective analytical view of what is driving cash flow in that business. Now, another aspect of this process, one of my favorite questions to ask business owners is, Madam Business Owner, what do you think your business is worth without you?
Yeah.
And, you know, I get various answers to that question. You know, sometimes I get what I call the chest pounders. This is predominantly men, but they tell me things like, what do you mean worth without me? I'm the guy that founded this business. I'm the guy that makes it tick. I'm the brains and the energy and the inspiration behind this business. And I typically will say, well, Mr. or Mrs. Business Owner, that's unfortunate, because that means the business doesn't have much value because you, the business owner, doesn't go with the business when you sell it. So it's a way of emphasizing to business owners that they have to develop a turnkey operation. And the goal for the business owner has to be that this business can continue to generate cash flow even when I'm not here. So you talk to business owners about things like, you know, what's the longest vacation you've ever taken without checking in with the business? And, you know, that's a sort of indicator of how much of a turnkey operation this is. Now, I think I do a pretty good job in valuing businesses. I have a lot of experience. And I usually do a calculation of value versus an opinion of value, only because, you know, opinion of value costs a lot more, but I don't think the business owner typically needs that. Yeah. I do opinions of value in a litigation setting, in a gift or estate tax setting, or a shareholder dispute or a divorce context. But when a business owner wants to just know what this business is worth for exit planning purposes, the calculation of value is generally what they need. So, you know, you have to be able to tell your client that you're giving them good value, you know, for the cost of your services. And I don't think in most cases the extra cost of an opinion of value is warranted in an exit planning context. Feel free to interrupt, but just address.
Yeah, so let me just, I didn't want to interrupt for a second. So a lot of owners, if they think they need to know the value of their business, they're not going to want to spend any money. So they're going to turn to a software calculation. But that's going to give them a number.
Right.
It's not going to really tell them why that number is accurate or not. It's going to just be based upon what other businesses have sold for. What you're doing is laying the groundwork for why the business has a certain value, but you're also pointing the owner to areas where the business could grow. Because if the business is the owner, then clearly we need to develop a management team and operating systems and things like that. So you're going beyond, really far beyond what a software derivation of value is.
Okay, and I'm glad you raised that, John, because that's kind of where I was heading. So I was a user of BizEquity. I subscribed to BizEquity because I wanted to know what the competition was. And I believe they're based in Philadelphia, which is near me. And I had a number of conversations with some of the people in Philadelphia about BizEquity. And I thought for a software program, BizEquity was pretty good. The problem is that BizEquity is a black box. You put all sorts of data into the black box, and it spits out a number, but it doesn't really explain to you what's behind that number, what's driving the value in that business. So it has some usefulness to business owners, but at only a pretty high level of generality. It's not going to tell the business owner what you're doing right, what you're doing wrong, what the opportunities are, what you need to increase the value of this business, what you need in order to sell it to a third party. So it does have some usefulness, but from my perspective, it's never really enough to drive the exit planning process.
My view of software programs in general is it's a lot better than relying on the owner's determination of value.
Yeah.
Because it seems like they're going to be more realistic and closer to maybe what a calculation of value would result in. And so for that purpose, it's telling the owner the value you thought was up here, maybe 10 million, is really only 4 million or 5 million because you're lacking a lot of the values that drive the business forward. That's what you can do. That's what evaluation, calculation of value in my mind seems to do then, is it not only tells the owner more realistic value, but also points them in the direction of what they need to begin doing.
Yeah, I think that's a fair assessment. For example, a biz equity, and I don't mean to pick on biz equity, it just happens to be the one I'm familiar with. And in my experience, it was a pretty good software package for what it did. But if it comes out with a value of 4 million, it doesn't really tell you if that business is saleable. And business owners don't, apart from the issue of value, they don't have a good understanding frequently of what makes a business saleable. And when you do a valuation report, that's a key factor. If we have a business that's highly dependent on the owner, that's going to impact the value and impact the saleability or marketability of that business. And that kind of information is just as important to the business owner as the numbers. Mm-hmm. So that's my perspective. And I think you're right, John, that a software program is probably better at giving a general idea of value. It's generally better than the business owner taking a stab at it. So, those software programs do have some value in that regard.
Yeah, I mean, what we talk to when we talk to our members about a business valuation, the approach that BEI tends to take is, if the owner is unwilling to pay for a valuation, calculation of value typically, then we can start off with software. We can start off with that value, but we're not going to base any decisions, actually transfer of ownership decisions, on that valuation.
Yeah.
And that seems to work because it's so important for owners to have some basis, some logical, historical basis for what their business is worth, rather than the owner guessing at what the value of her business is.
Yeah. No, that makes a lot of sense to me, John. I guess, and I know there's a lot of cost pushback in the valuation realm when someone says, well, the software will give me a number for $500. Why should I pay you $10,000? And, I'm sensitive to that, and I want to be in a position where I can explain to the business owner what additional value they're getting for their dollar when they use my services and where that's likely to take them. So I tend to make, partly because of my background, but partly because I think it's a great entree into exit planning, I tend to make the valuation the initial focus of the exit planning process, because it teaches me so much about the business, and it teaches the owner a great deal about their business that they might not have been aware of, or they might not have fully understood the impact it has on value.
That is very perceptive. That's a great insight.
Yeah.
And at the end of the day, it's reasons like this that gets owners to start planning. And, it's really, why do we plan? We plan because the valuation is this, and it also indicates here are some things you need to start thinking about. And from there, Don, it sounds like you transition from a calculation of value into the planning for the future of the owner and the business.
That's typically the way I work.
Yeah.
Although I have to say, some engagements, I don't always do the valuation. There's some engagements that I have where the owner has already gotten a valuation, and that's fine. And I never insist that I'm the one that does the valuation. I am perfectly happy to work with other people's valuation. But it's important to have some starting point, I think, for the planning purpose. And I think evaluation is a great starting point.
So Don, tell us a little bit about your perspective of having an investment banker provide an owner with a range of a likely sale price for her business.
Well, I like to say a good investment banker or a good business broker is worth their weight in gold. And somebody, and I want to define what I mean by a good investment banker or a good business broker. Somebody who can come up with a realistic estimate of value, and the range of value that these bankers and brokers come up with can be very good. Now, the only thing is, a banker or a broker, they're focused on making the sale, and that's appropriately so. They're not so much interested in building the value of the business over a long period of time. And it's not anything negative about them. It's just not the way they work.
Right.
And so what I like to do is I like to, when we determine in the exit planning process that a third party sale is the way to go, then I like to turn my client over to a good investment banker or broker. What I am primarily concerned, one of the things I'm primarily concerned with is somebody that's going to really work hard to sell this particular business. Because, the market, the industry of bankers and brokers has lots of great people in it, but it has a lot of people in it who have a different business model for success. And they might be more interested in recruiting prospects and getting paid upfront fees than actually focusing on selling every business that they've contracted to market. So, and like everybody else, I've had bad experiences with brokers and investment bankers, and I've had some really good ones. So I think one of the really good value-added services I can provide to my exit planning clients is hooking them up with the right broker or investment banker. And the couple of reasons. First of all, I'm confident these people are going to do a good job. And also, I tell my clients, it allows me to sit on the same side of the table as a business owner in evaluating the deals that come down the pipe from the bankers and brokers. And I help them make decisions about what's a good offer and what's not such a good offer. So that's typically where my third-party sale transactions go.
Interesting. Yeah. Interesting. Well, that's all good. So let me ask you one more question. What should owners and exit planning advisors look for in hiring a business appraiser? What qualities should they be looking for, experiences, and so on?
Yeah. I would say that you really ought to find somebody through personal referrals. That is, if you're a lawyer or you're a CPA and you got a client that's going to sell, talk to people who've had good experiences with an investment banker or business broker. And that for me is the only reasonable way I know of to find somebody good. And I do that all the time. You know, I have some clients in different parts of the country. And you know, I happen to be working with some businesses right now in Minnesota. I'm located in Pennsylvania. And one of them wants to sell to a third party. Well, I don't know business brokers in Minneapolis, St. Paul, or Rochester. So what I do is I sort of exhaust my network of contacts to find somebody who's had a good experience with a business broker or investment banker in that area who can do a good job for my client. Or I'll talk to CPAs in the area, or lawyers to try to get a good referral. And that's the way I go about, you know, finding good transaction intermediaries for my business owner clients.
I think that's typical, very common with our exit planning advisors who are members, is they're not going to know all the people in a certain area, but it's doing exactly what you're doing. It's basically interviewing the person who is going to recommend somebody and then talk to that person. But let me ask you, let's get down to certified valuation analysts. What should an owner look for? What should an exit planning advisor look for in deciding to hire a business appraiser?
Yeah. So I think, you know, the most common problem business owners have is being cheap and not being paid.
I think that's a fair statement.
You know, and this might appear to be self-serving, but you know, 25 years ago, I was first doing valuations. There weren't that many of us around.
Yeah.
Now valuation gals and guys are a dime a dozen. Everybody's doing valuation. And, you know, it just, in a way, makes it harder to find somebody who's good. And so I would not choose a valuation analyst because you might save $1,000, $2,000 on the price. And that's just the way it is. People who are good charge a decent price for their services, and they have enough business and enough customers, so they're not competing for your business on price. And what else should you look for? Again, you know, there's a lot of different credentials, and all the credentials are decent credentials, you know, between ASA, CVA, ABV, you know, the main credentials. I wouldn't say you should pick one credential over another. But again, I would try to get personal referrals.
Mhm.
You know, ask your lawyer or ask your accountant or ask your financial advisor who does a good job.
Mhm.
And that's the only way I know of to try to find somebody who's decent.
Yeah, I think that is clearly the best way, is to talk to others who have experience. I guess what I was thinking of also, though, is there's so many CPAs who get a valuation credential,
Yeah.
and then they do a valuation every other year, or only when somebody comes to them and says, "Hey, I need a valuation for something."
Yeah.
They don't really have. They may have been a credentialed for 10 years, but maybe they've only done 15 valuations. And it
Yeah.
strikes me that the really good business appraisers are clearly credentialed, but they also are doing business valuations as a focus of their practice. So their experience is so important, as you know, in professional representation in general, but I think especially in business valuations, because there's so many variables to look at, and they're not necessarily black and white.
Yeah.
It's judgment calls.
The other problem with some CPAs is that they use software products to do their valuations. And there are software suites out there, not BizEquity, but other programs, which, and I have experience with some local CPAs who might do 15 or 20 valuations a year, but they're pretty much all spun out of a software product without a lot of serious analysis. And I've actually started to work with one of these CPAs to help him develop a little bit more serious practice. And I do consulting for that CPA firm to try to help them upgrade their valuation practice and give them a better perspective on what's involved in a serious valuation report. So that's another, danger. And sometimes I run across this in my exit planning practice, where somebody will present me a canned report. Again, not BizEquity, but something done by a CPA that really is not up to what it needs to be.
Excellent.